Hello, financial enthusiasts! Welcome back to our channel where we reveal the secrets to financial success in building a solid foundation for a brighter future. In this video, we'll take a look at the interesting world of futures trading. Whether you're an experienced investor or new to the game, futures can provide a variety of options for those wishing to diversify their financial portfolio. When watching investment news channels, you often come across ribbons or tables displaying future prices of commodities. For instance, you might see that gold futures are trading at $1,500 or oil futures are trading at $55. It's important to note that these prices do not reflect the current trading prices of the commodities. So, what do these futures represent? Essentially, they indicate the anticipated prices at which these commodities will trade at a later date. These numbers are linked to a financial instrument known as futures contract. Futures involve the buying and selling of assets, typically standardized commodities, at a predetermined future date. While initially designed for producers to manage business costs, futures have now become an integral part of the investment industry. Futures contracts have multiple applications, and although they can be complex, when used effectively, they can significantly impact the characteristics of your investment portfolio. Today, we'll delve into futures, their association with forward contracts, and explore the reasons why people utilize them. Let's embark on this journey to gain a deeper understanding of futures and their relevance in the world of investing. In today's scenario, let's imagine you're a bagel baker. Your bagels are sold for $6 per dozen, and let's assume that the only ingredient you use is flour, which costs you $4 per batch. Your bagels are fantastic, and you manage to achieve a gross profit of $2 for every dozen bagels you sell. This profit margin is satisfactory for your small-scale operation. However, the cost of flour is a critical factor in maintaining this profit margin. If the cost of flour were to increase, let's say to $6, it would create a challenging situation for you as a baker. As a proactive business owner, you take initiative and decide to establish a supply agreement with a flour producer. This agreement ensures that in a year's time, you will purchase flour from them at a predetermined price. By doing so, you secure the ability to buy flour at a consistent price in the future. While this approach may limit your potential to benefit from a decrease in flour prices, it also eliminates the need to constantly worry about market fluctuations. Instead, you can focus more on your bagel making operations, knowing that the cost of flour is fixed. It provides you with a way to mitigate uncertainty and maintain stability in your business by setting a predetermined price for a commodity or asset in the future. Essentially, this is akin to how a futures contract operates. A future is a financial agreement where the scale of a specific item occurs at a predetermined price known as the forward price, which is determined today. The person who agrees to buy the item and pays the forward price is referred to as the person going along on the contract. In our case, the baker takes on this role. On the other hand, the person who sells at the forward price, which is the flour producer in this scenario, is called the person shorting the contract. When someone enters into a future contract, they are obliged to complete the transaction for the underlying assets on the agreed delivery date in the future, regardless of whether it turns out to be profitable or not. Originally, these contracts were used by companies to manage their costs, as illustrated in our example. However, nowadays, future contracts are widely utilized by speculators seeking exposure to various commodities such as oil, orange juice, precious metals, and livestock. They can also be employed to gain exposure to financial assets such as individual stocks, treasury bonds, popular indices like the S&P 500, and even Bitcoin. So how do futures provide speculators with exposure to the price appreciation of an asset? Let's walk through an example. Suppose you're interested in investing in gold because you anticipate an upcoming recession and believe that investors will seek the metal as a safe haven, driving up its price. The current market price or spot price for an ounce of gold is $1,500. However, you don't want to physically buy and sell commodities. Instead, you turn to the futures market, where you can obtain 100 ounces of gold in 1 year's time at a forward price of $1,550 per ounce. ounce. The higher future price reflects various factors like inflation, risk-free rates of return, and the costs and income associated with holding the asset. Generally, future prices will be lower for assets that offer benefits to hold, such as dividend-paying stocks, and higher for assets that are costly to hold, like cattle that require feeding. By buying the asset in the future, you avoid those holding costs and transfer them to the person shorting the contract. Consequently, the future price compensates them for taking on these costs. There is a specific formula for determining the price of a future contract, but delving into it would require a separate video. Therefore, let's stick to the basics for now. Returning to our example, let's consider the gold contract. You decide to take a long position, agreeing to buy 100 ounces of gold for a total of $155,000. The price per ounce multiplied by 100 ounces. The profit you make on this investment, or your return, will depend on the spot price of the asset when the contract expires in 1 year. If the price increases above $1,550, let's say $1,700, then you will earn a profit of $15,000. This is because you will purchase the gold for $155,000 and sell it in the spot market for $170,000. On the other hand, if the spot price falls to $1,400, you will incur a loss of $15,000. This is because you will have to buy the gold at a future price that is higher than the current spot price. But what if, instead of anticipating an increase in gold prices, you actually expect them to decline? In the case of an impending recession, you might assume that the government and central bank will take measures to stimulate the economy, encouraging investors to shift from gold to the stock market and consequently depressing gold prices. In such a scenario, you can take a short position by agreeing to sell the gold in 1 year's time, essentially reversing the potential return. If the price falls below $1,550, you would be able to purchase gold at the lower spot price and sell it at the higher forward price to make a profit. Now, you may be wondering about the practicalities of receiving or delivering 100 ounces of gold if you decide to short the contract. While you might be able to acquire a few ounces from a local pawn shop, it's unlikely that the exchange would accept second-hand wedding bands and watches as payment for the contract. While you have the option to choose a future contract that involves physical delivery of the asset, it's also possible to design a contract that settles in cash. This means that the actual exchange of the asset doesn't take place, and instead, cash is debited and credited to the appropriate accounts. Additionally, you have the flexibility to cash out of your position before the contract expires by offsetting it against an opposite position. For instance, if you initially short a gold future contract and decide to exit your position halfway through, you can do so by taking a long position in a contract with the same underlying asset, quantity, and delivery date. By doing this, the two contracts effectively cancel each other out, and you will earn a profit equal to the difference in the future prices. The reason such netting is possible is that future contracts are highly standardized and traded on exchanges. This means it is relatively easy to find both long and short positions for a 100-ounce gold contract through your broker. There are also more flexible contracts called forwards, which are negotiated directly between parties and can involve any quantity of the underlying asset. However, forwards are primarily utilized by companies for hedging purposes and are less commonly used by speculators. Futures contracts offer a convenient method for gaining exposure to commodities, but like any investment, they come with their own risks. One notable risk is the use of leverage, which magnifies both potential gains and losses from your investment. We have covered leverage in our video about shorting, which you can refer to for further details. In summary, futures contracts only require a fraction of the contract's value to be invested by the speculator due to the utilization of leverage. In our example, if we had taken a long position in the $155,000 gold contract, our broker would initially require us to deposit a margin. This margin is a percentage of the contract's value that serves as a deposit on the position. For instance, you might only need to have 5% of the $155,000 contract, which amounts to $7,750 in your account. While this may appear convenient, it exposes investors to significant potential losses. If gold prices were to drop to $1,000 per ounce, you would suffer a loss of $55,000, representing a 710% loss on your initial deposit. It goes without saying that futures contracts are not suitable for inexperienced investors. While they may seem relatively straightforward, they have a wide range of applications. They not only provide exposure to specific assets, but can also be used to fundamentally change the risk-return characteristics of a portfolio. They allow investors to mitigate or eliminate market risk and even lock in returns from certain positions. Furthermore, investors utilize futures prices as indicators of consensus estimates and join other investors in understanding what the market perceives as the value of an asset. Additionally, futures prices offer insights into the price patterns of the asset. You can visually represent these price patterns using a tool called a futures curve. This graph displays the forward prices of an asset for various contract expiration dates. In the case of gold, the curve typically shows an upward slope, indicating that you would need to pay more if you would want to buy gold at a later date. This curve may change over time to reflect shifting market dynamics. Let's consider the future curve for natural gas as an example. Notice the cyclical nature of the curve. This is because the price of natural gas is heavily influenced by seasonal factors. More natural gas is purchased during the winter months for heating purposes, resulting in higher forward prices for those periods. As you can observe, futures curves provide valuable information, and there are numerous ways in which investors utilize them to gain insights and make informed decisions. Although I have only touched on the applications of futures contracts, I hope I have provided you with enough information to grasp the basics of how they function. Futures contracts are not typically a standard part of a portfolio, and it is important to seek further education before investing in them. The next time you come across that smaller number in the corner of your screen, take a moment to appreciate its significance and the glimpse it offers into the future. If you enjoyed this video, please consider hitting the like button. If you appreciate what we're doing here, make sure to subscribe to our channel and click the bell icon for notifications about future videos. If you have any feedback or topics you would like us to cover in future videos, feel free to leave a comment below. Thank you so much for watching, and see you in the next video.